how can an investor make long-run profits from short-run trading? What we want to think about is whether it's necessary for the peaker has a fairly low capital cost. So the question arises, can we build it without a long-term power purchase agreement? Would it be possible to build this plant on a speculative basis and run it without a long-term power purchase agreement? Long-term power purchase agreement is going to help us with financing, but for a power plant with a fairly low capital expenditure, it might be possible to arrange the financing without a power purchase agreement. So we want to see how we could make this work, because this might tell us some things about the types of contracts we might want to write for larger power plants as well. So how could an investor make this work? The idea would be to build a peaker unit without a power purchase agreement. So the only time you'll be running the peaker is when you can sell its services on the market for a price greater than the marginal cost of running it. And of course you have to expect there are going to be times of very high prices that will give you scarcity rents that will justify having built the plant in the first place. So what could an investor do? Well, you could watch the price on the electricity exchange and generate and sell electricity whenever the price on the exchange is above the marginal cost. And in order for that to work, there have to be sufficient buyers in the exchange for the time the peaker is available. There have to be sufficient buyers in the exchange to provide the investor with confidence to know that there will be plenty of buyers in the exchange to sell whatever electricity can be generated with the peaker. It requires a certain amount of liquidity, a certain level of participation in the exchange, so that you're confident whenever the price is high enough to justify running the peaker, there will be buyers in the exchange for what the peaker can generate. In countries like the U.S., where I have my knowledge is strongest about the way the institutions work, the generators will bid into day-ahead auctions or into the real-time market for providing electricity, and that's similar to the way it would work if a generator were using the exchange as their vehicle for selling their electricity. So under these circumstances, suppose that the only opportunity, there's no long-term contract here, the only opportunity is for selling in the exchange. Well, if you can average a 30% capacity factor selling electricity into the exchange, then you can make a profit. As long as the price is going to spend enough time above the levelized average cost. If you know the price will spend plenty of time above the levelized average cost, then you'll be able to run this plant at a profit. And remember, this is done without a long-term supply contract. This is done by assessing the amount of time you think the exchange will spend at a price high enough to justify running your peaker unit. And as long as there's plenty of time where it'll be above your levelized cost of energy, then it was worth investing in the power plant, even though a lot of the time there's going to be a price too low to justify running the peaker. The times when it is worth justifying running the peaker will be profitable enough so that it would have been worth building. This investment is risky, so it'll require a higher rate of return for an investor than a less risky asset. On the other hand, given the prices given the history of prices, it gives us confidence that they'll be spending enough time above the levelized cost of energy. It would be worth building the plant, and because the risk is higher, the return would be higher as well.